It is often advised that one should only invest the money they're willing to lose. This is because most investments are uncertain, especially in the bear market. Hello and welcome to my channel Knowledge Seeker. It's good to have you here. Today in this video, we'll be sharing with you all you need to do to become a pro when investing in the bear market. However, before we go on, take a moment to like and subscribe. Thank you. Now, here's a fact. Nobody wants to see their investments decline, much less crash. This is why the dreaded bear market is so unsettling. Securities often lose at least 20% of their value in these markets, and there is a great deal of pessimism. A bear market is described by economists as a prolonged broad price decline of 20% or more. A bear market doesn't seem like a good time to invest. You spend 1,000 euros on something. The value is 998 euros and 50 cents the next day. After a week, it is now worth 952 euros. It seems like a surefire way to lose the money you've invested during a bad market. Bear markets, however, have an interesting fact. They present little threat to the astute investor. If they employ the proper techniques, there can even be excellent chances to turn a profit. So, here are 10 ways for you to make wealth in the bear market. Hold on. It can be tempting to attempt and reduce losses by selling equities as they start to decline during a bear market. Some claim that buying and holding during economic downturns is a fantastic good investment strategy for long-term investors. In reality, according to a recent analysis by Crestmont Research, the S&P 500 returned positive returns for any 20 years from 1919 to 2019. This indicates that everybody who bought an S&P 500 index fund between 1900 and 2000 and kept it for at least 20 years made money. Bear markets don't endure forever, and that's a crucial thing to keep in mind. There have been 26 bear markets in the S&P 500 since 1928, and they typically last 9.6 months and result in losses of 36%. Contrarily, bull markets, which have occurred 27 times since 1928, gain 114% on average over 2.7 years. Broaden your portfolio. Whether there is a bull or bear market, broadening your portfolio is generally a wise move. The goal of diversification is clear if you've ever heard the adage, "Don't put all your eggs in one basket." You might increase the likelihood that some of your investments will gain or hold stable, while others decline by diversifying your portfolio. You can use this to generally hedge your losses. A diversified portfolio's 4 main categories are domestic stocks, international stocks, bonds, and short-term investments. Keep your eyes out for good deals. Even equities like Disney could experience a decline during bear markets. Bear markets may be viewed as an opportunity by astute investors rather than a defeat. There is also a higher likelihood of finding a deal while the economy is struggling. For this purpose alone, Warren Buffett frequently purchases during weak markets. He even referred to the 2007 to 2008 bear market as an excellent opportunity for investors at one point. Buffett is aware that unstable markets breed worry, and that fear can cause stock sell-offs at discounted prices. The only source of this anxiety frequently is a declining market. To put it another way, when excellent companies are being sold for less money, it isn't because investors are worried that they won't succeed in the upcoming years, but rather because they are afraid of everything. A discount purchase of a no-brainer company is sure to pay off as usual when the market ultimately recovers. Invest short-term. Falling market prices may present exceptional prospects for short-term gains. Some short-term investing techniques can be appealing choices for people ready to take a chance even if they are less secure than long-term investing strategies. One short-term investment strategy is put options. A put option gives its owner the right to sell a stock or other asset at a fixed price, known as the strike price. When the value of the underlying asset declines, it typically increases in value. You can also consider exchange-traded funds, ETFs, with an inverse relationship to significant index funds, such as NASDAQ ETFs increase when large index funds decline. Investors may find this useful in hedging against market declines. Hedge your bets. Since the stock market has traditionally recovered after downturns, long-term investors may find bear markets to be excellent occasions to invest in the dip. When should you buy it, though? Consider a situation where a stock's price falls from $100 to $70 per share. Although it could seem like a good moment to invest, the stock may tumble further until it reaches a low of $50 per share. Don't try to time the market to protect your investments. Instead, think about employing dollar-cost averaging. With the use of this strategy, you could potentially spend less on stocks. Use this method by making regular, equal investments in your preferred stocks. You might easily average out your buy-in price by making numerous purchases at various times and prices. This might assist you in avoiding overbuying to profit from a market that is declining. Buy dividend stocks. Purchasing equities that pay dividends as opposed to those that don't is another approach to protect yourself from bad markets. The average yearly return on dividend equities from 1972 to 2012 was 9.5%, according to data from Ned Davis Research. This is in contrast to the non-dividend paying stock market's typical yearly return of 1.6%. Although this distinction may appear significant, it makes sense. Dividend-paying stocks are often successful year after year and well-established. Invest in defensive stocks. Consumers frequently choose defensive businesses even during difficult economic times. Consider essentials like toothpaste or shampoo. You can give your portfolio a balancing branch by making investments in these recession-proof sectors. You can purchase exchange-traded funds, index funds, or individual stocks in defensive industries. These funds own stock in many businesses, which aids in portfolio diversification. You may, for instance, invest in a consumer staples fund to get dividends from several businesses that make goods that are regarded as necessities. Invest in growth stocks. While growth companies generally outperform value equities in a bull market, the opposite is true in a bear market. For 90 years, a report by Bank of America Merrill Lynch investigated the effectiveness of growth and value stocks, 1926 to 2015. Value equities performed better than growth stocks overall, with returns of 17% versus 12.6%. However, growth stocks turned out to be the stronger performance in struggling economies. Try the lipstick theory. According to the lipstick effect, sales of inexpensive luxury items like lipstick will rise while the economy is struggling. While consumers won't be able to buy more expensive luxury items, the thought is that simple things can lift morale during tough times. Investors that have some spare cash may benefit from looking at cosmetic, beauty, skincare, or fragrance brands. However, it's not a sure thing. Go for gold. Money has traditionally been invested successfully in gold. Compared to the stock market, its value fluctuates less frequently. It is therefore a fantastic hedge against difficult times. There are several ways for investors who want to invest in gold. Ways like investing in bullion, purchasing gold-backed ETFs, and purchasing gold mining stock make up for good investments. No doubt, a quick way to get cash is by selling gold. Then, to further position your portfolio for a down market, reinvest this money into dividend, growth, or defensive equities. If you ask many people about bear markets, they'll tell you it's a sign of impending danger. You can't tell when it's going to start and when it'll end, nor how it'll affect stock prices. This is because downward slopes are part of market events. However, you can put yourself in the right position to benefit from them. While many investors pull out their investments in bear markets, the key to succeeding in these times is diversification. Proper diversification pulls you through bear markets with little or no stress. Follow these wealth-making ideas, and you'll thank me later. Alright, that'll be all for this video. The steps to making wealth in bear markets are specifically and carefully picked out for you because we care about your investments. Don't forget to like this video and drop us a comment in the comments section. Also, click on the subscribe button, and if you'd love us to notify you when we have new videos, do click on the notification button. Thank you.